Welcome into the Ether, a podcast brought to you by ETHUB, the essential source for Ethereum information. Kyber Network has been one of the most successful DeFi projects to date and is the liquidity backbone for many token swaps occurring on the Ethereum chain. They have just launched a major protocol upgrade called Catalyst, and with it comes the launch of Kyber DAO, a community platform to facilitate the decentralized governance of Kyber's protocol. KNC holders can now stake their tokens to vote on important proposals in the Kyber DAO and in return earn ETH rewards in the process. Head over to kyber.org to get started. Hello, everyone, and welcome into the Ether. Today, my guest is Robert Leshner, founder of Compound, a staple in Ethereum's rapidly growing DeFi space. Thanks for joining me today, Robert.
Yeah, Eric, thanks as well. Happy to be here.
Yeah, absolutely. This is actually your second appearance on the show, but it's been a while and a lot has happened for Compound over that time. And eventually we're going to kind of dive into that and what you guys have been releasing lately. But kind of for the people that maybe didn't listen to the last episode, can you just give us a bit of a background on yourself and then eventually how you got involved in crypto?
Yeah, absolutely. So I started my career as an economist, focused on understanding interest rates. And after that, I became a traditional software entrepreneur, building web stack products. And when Ethereum came out, for me, it was sort of this like Venn diagram overlap of my two passions, money and programmability. And it was really awe-inspiring in a lot of ways. And I, was just blown away. And I asked the question, well, what can we do with this? We're presented with smart contracts. It's an entirely new technology. What's able to be built for the first time that just couldn't be built prior to this? And it led to the sort of realization that we could create entirely new financial products and markets. And pretty quickly that became Compound, building interest rate markets for Ethereum assets.
Nice. Yeah. And I think you guys have really kind of helped lead the way when it comes to DeFi and kind of, slowly breaking into that mainstream adoption. And I want to dive, like I said, a little bit deeper into what you guys have been doing recently. But first, can you just give like a high level overview for people of what Compound is? Kind of how do you explain it to people that haven't heard of it before?
Yeah. So Compound is a series of interest rate markets for different Ethereum assets. Predominantly, this is Ether and stablecoins and a couple other utility tokens. And in each of these markets, there's an interest rate that you earn when you supply the asset to the market to be used by other people. So if you're sitting on a stablecoin or you're sitting on Ether, whether you're an individual, a smart contract, an application, an institution, you can supply it to the protocol to earn an interest rate. And if you want to borrow any of these assets, you can borrow them from the protocol by paying whatever the prevailing interest rate is, by providing the protocol with some collateral so that you can't just run away, and then being able to instantaneously have access to any other asset. And what makes this really interesting is, the entire thing is run by smart contracts and very basic algorithms. So instead of you having to figure out like, this is the interest rate I'm willing to pay, or this is, the terms that I want to seek, you simply accept a prevailing interest rate that the protocol offers. And that interest rate is set by supply and demand.
Yeah, I've always liked, especially out of the box, how many different assets were there. Just kind of, I think the initial stab at this was Maker. You could lock ETH and draw DAI. Just being able to lock different assets and draw out different assets was kind of a cool breakthrough at the time. And I think it's, you guys have seen big success with it. And last time we talked, it was 18 months ago. You guys were still on V1, if I remember correctly. Can you just kind of walk us through the evolution of Compound so far from like initial idea to V1 to V2? And then, I want to lead this into the recent release of Comp and the governance, and we'll dive in deeper there.
Yeah. So we started the project in October 2017, and we really began with R&D. We weren't really sure what was possible using smart contracts. A lot of people were doing early experiments with Solidity and smart contracts, but there weren't too many like mainstream products that were built yet and widely used. And so at that time, we really were just trying to figure out how we could build what is now Compound. It wasn't until September of 2018 that we released the first version of Compound, which is basically a year later. There was basically a year that went into building the very first version. And it supported a couple assets. We actually launched without a stablecoin, which is funny because now stablecoins are like the predominant use of Compound. We didn't even realize that stablecoins would be so important when we first launched. It just had Ether, Basic Attention Token, 0x, and Augur, and it was a very simple system. It functioned similarly to what exists today, but it was the first attempt that we had to be able to prove out the mechanics, the economics, whether or not an algorithm could work to set an interest rate, whether pooling liquidity was a useful concept. At the time that we launched, none of these things existed, and now they all seem so commonplace where you're like, oh yeah, there's a pool of liquidity that you contribute to. But that was pretty innovative at the time. And so Compound V1, has basically been the basic mechanics of the protocol. We saw what we liked and what we didn't like about the first version of it, and we used that to tweak the methodology. We made some improvements. We tokenized balances. These are called C tokens. So when you supply an asset to the protocol and you're earning interest, we basically give you the receipt in your wallet, which you can program, you can send around, you can do other cool things with. Developers love to build new use cases with these. And otherwise, it's been a pretty consistent theme. There's interest rates on Ethereum assets. And what we've wanted to do is build a system that works reliably and predictably, and remove ourselves from the equation as much as possible. And this has really led over time to launching what we view as the final version, V2, and then continuously removing the Compound team from the functioning of the protocol. Now all decisions to upgrade the protocol originate from the community. So it's now decentralized development of the protocol. And that's been embedded through what's called the Compound Governance Token, or COMP.
Yeah, and one thing quickly, you mentioned C tokens. That was one of the things to me, which was it was a pretty big innovation, and I think really helped push adoption of V2. It's so nice how, like you just mentioned, it, developers love it, and you kind of have these tokens that represent your share and your interests, and they're growing over time. But you can take them and plug them into other places in DeFi. Was that kind of just like how did C tokens come about? Was it just like an aha moment and then you guys were like, holy crap, this is actually pretty powerful one day? Or was it something you've been thinking about for a while?
Yeah, that's a great question. So if you go all the way back to V1 of Compound, we had this thesis that we talked about publicly, which was Compound is a tool for other developers. Other smart contracts are going to supply and borrow from the protocol. And when we launched V1, we found that there was like a lot of individual users, but we actually had very little developer interest. Our thesis was that Compound would be built into other smart contracts, but we launched and we are sort of waiting, and then nothing really happened. And we spent a lot of time talking to developers, asking them like what they liked and what they didn't like about building on top of Compound. And we did a lot of thinking. There started to be some conversations in the community at this time about like how do you increase composability. This was like a big word that started to emerge in 2018, and the mission became, how do we make Compound more composable with other projects and protocols? What makes sort of the DeFi that we have today? And in a lot of ways, the ERC20 standard is kind of like the glue of all of DeFi. Almost everything has like inadvertently run on ERC20. It's become a very basic standard. And so by turning all the balances inside of Compound into these ERC20 tokens, it just natively out of the gate made Compound supported by all of these other projects where you could trade tokens, you could, move tokens more easily. Like, even though the basic functionality of Compound didn't change, just having these balances as an ERC20 version right out of the gate just increased composability. And that was, sort of the thinking that got us there.
Yeah, it's been a powerful tool for sure, and I think I totally agree. Composability and ERC20s and all this is so vitally important. Is what's making DeFi explode. I mean, anybody sitting at a computer can build an integration in these protocols pretty much overnight, and that power there is just unstoppable, I think.
Oh, it's been great to watch all of it evolve.
Yeah, absolutely. So I want to shift now to kind of what you guys have been working on recently. I think that's a good background and history of the protocol. You mentioned already governance and turning over governance from your team to the decentralized community. So I guess with that, let's start with Comp, which is the governance token that you guys have recently launched for people to, be a part of the governance of Compound. Can you just give us and explain, like I'm five, what is Comp? And I guess more importantly, like, because to me, it's interesting to think about turning over a project from a team that can, sit in a room together and make decisions on the protocol to token holders spread across the world. There's a lot of complexities that go into these products. Can you tell us what can comp actually change on the protocol? Is it everything? Is it certain parameters, or kind of what are the limits there?
So to start with, comp can change everything. The whole protocol was designed to have an admin address, and this address can be, a vanilla Ethereum address. It could be a smart contract. It can be a DAO. It can be any system possible. What we did is we replaced the administrator address of the protocol from being an address controlled by our company that originally built the protocol to a governance system, which is basically a smart contract plus a token that controls the entire protocol. Anything the original developers are able to do, that was eliminated and replaced with compound governance. And so at this point, the token holders have an ability to vote on actions that are administrative actions, changing any parameter, changing any contract, changing any structure of the way that Compound works. They have full and complete control over the protocol, and everything that was originally in our team's control is now in the control of comp token holders.
Gotcha. And when it comes to this stuff, I find it important to talk about distribution and how this is going to be distributed over time, because obviously you don't want just a couple people in control of this, right? So can you kind of talk about what does the initial supply distribution look like for this? Kind of how are those decisions come to, and then how is this distributed to the community over time?
Yeah, so I think it's actually important to start with some background on how comp works, because it's not a standard ERC20 token. And so I think a lot of the traditional paradigms about thinking about this stuff don't apply. The most important is this concept of how the governance system actually operates. And it's based on one of delegation. So the way this works is any comp token holder can delegate their authority and votes to any other address. So if Eric is a distinguished member of the community, any comp token holder can assign their votes to Eric. And in this way, Eric doesn't have to own any tokens. He doesn't have to, have received any tokens, but he can have sway and influence and authority over how the protocol is upgraded. And so this voting mechanic called delegation is baked directly into the token. A lot of this behavior was inspired by, delegated proof of stake blockchains like Tezos. And it's been used since the very first day that the token was created. And a lot of the votes are actually delegated to members of the community by anyone who's holding the token. We encourage people to become active in the community, active in governance. There's a phrase called protocol politicians that's circulating. We encourage people to be protocol politicians. The token functions where you don't have to be an owner or holder of it to be able to use it. And that's really cool. And so the way the token's distributed is an initial batch of tokens was distributed to the team that built the protocol and the backers of that team. And the rest of the tokens are being distributed to members of the community. And that distribution is occurring over 4 years. So anyone who uses the protocol, in the same way that people have used the protocol for 2 years now, receives these governance tokens. And from there, anyone in the community can mix and match how they assign votes, who they delegate to, how they vote, why they vote, when they vote. And a much more complex governance ecosystem emerges on top of the distribution of the tokens.
Yeah, the delegation's interesting. I think it was one of your motivations and hopes there to get better voter turnout. So basically, what we see in a lot of protocols that have voting tokens, I don't want to pick on anybody, but let's say ZRX or Maker or whatever, voter turnout's pretty low because everybody has to individually go in and vote. Was that kind of one of the main motivations behind delegation?
It is. And we were also inspired by a lot of what I'll call traditional real world use cases. So, everyone owns shares of stock. How many people are voting on those shares of stock? And how many people actually want to exert governance over the companies that they're investors in? Very few, right? You probably hold stock and you probably don't vote your stock. Instead, people essentially appoint others, to have their back and to represent them. This happens with board of directors. It's, the one governance use case of stock is to appoint other people to manage the system on your behalf. And so that was one of the primary motivations for us is, we basically looked and said, well, how do people use real world voting assets, right? Like most people aren't showing up at the shareholder meetings. They're not voting the proxies. They're just trying to find people who are smart and pay attention and are focused on maximizing the outcome. And so that was a big design decision for us, is enabling that exact behavior. It's directly related to participation rates, but we anticipate that over time, most token holders don't want to be in the business of voting. They want to find the people that do want to be in the business of voting, who care the most, who spend the most time, who put in the best research to helping to guide the protocol forward.
Yeah, I think it's a good idea. I think we're going to see this in a lot of protocols going forward. It makes sense from a participation standpoint, and I think people will want to just trust others with their votes, as opposed to, like you said, a lot of people hold stock, but very few actually go and vote on things that are put up to the board or whatnot. So I want to basically, you guys to me have created this meme that's going around of yield farming. So basically, people, like you mentioned, people can lock assets in the protocol and they're awarded comp. And this is happening over the years to come. I believe it's 5 years. Is that right? 5 years it's being distributed?
Yeah, it's a little over 4 at this point.
Okay, gotcha. So yeah, you guys have kind of memed this. I find this concept fascinating. I wanted to ask, I guess first, is this doing this, incentivizing people to come in the protocol and reward them for it? Has this been your vision from day one? And the reason I ask that is I find it interesting. Essentially, in a way, original investors, yourself, the team, are kind of diluting themselves to give out funds, but in return, I think creating users and incentivizing them to come use the protocol actually push the valuation way higher than it would have been, et cetera. But anyways, is this kind of been your vision from day one, or did you think at some point, hey, we need to actually find a way for people to come and use our protocol, and in return, we'll see, better feedback loop?
Yeah. So the only consideration was, how do we align the interests of the users and the protocol? And, there's historically people sold tokens, and that really puts tokens in the hands of speculators first and foremost. And the original hypothesis that we had was, well, is there a different way of going about this? Can we distribute the tokens for free to the people using the product already? They're the ones who probably care the most. One of the things that we underestimated was the sort of desire to hold the compound governance token. We actually didn't anticipate the sort of fervor to quote yield farm in order to get it. That caught us off guard, very deeply. But we did always have the idea that users should get the token for free, and that was important to us. And I think that long term it leads to a system in which the people using it, they know it best. They should be the first ones with their hands on the tokens, and it also aligns with how we see the protocol growing into the future. So the next vision that we have is that exchanges, custodians, wallets, applications, and smart contracts are going to integrate Compound. And when you integrate the protocol, just like any user receiving tokens, everyone who integrates Compound, the protocol receives Compound governance tokens. And this is a way of us aligning the incentives of developers with the long-term success of the protocol, making sure that anyone building on top of Compound gets a say in the future of it, gets to control the outcome, and gets the tokens. And that was really what's guided us in this format. It's a little bit sad because I think it's turned into yield farming, and we didn't anticipate that, but it does paint a very clear line from the users, whether they're people or applications, to the token.
Aave is quickly becoming one of my favorite DeFi protocols. And no, it's not because they produce the best memes in DeFi. Like other lending protocols on Ethereum, you can trustlessly earn interest on your crypto or take out a loan. However, they are pushing the envelope with unique features such as the new money Lego, Flash Loans. Flash Loans allow borrowing of collateral and repaying it in the same transaction. This opens up endless possibilities such as swapping out collateral on your Maker Vault, unique arbitrage opportunities on decentralized exchanges, and much more. Head over to aave.com to check it out. With the rise in popularity of DeFi, it has quickly become overwhelming to manage assets, investments, and yield farms. Zaprify eases this pain and helps you take control of your DeFi life. Zaprify offers a DeFi dashboard that displays all of your assets and debt in an easy-to-use interface. Simply plug in your address and the rest is done automatically. On top of that, it displays all available liquidity pools on Curve, Uniswap, and Balancer, and allows you to invest in them with just one click. If you're active in DeFi, honestly, this is an essential tool you need to be using. Head over to zapper.fi to check it out. I think we're still in the, I think I would say experimental phase when it comes to decentralized governance. We're just seeing, just like Compound embarking on this. Do you have concerns potentially about the future? I mean, maybe not governance capture, but maybe just voters aren't in tune with what's best for the protocol, or changes are happening too fast and maybe there's repercussions because of that. Do you hold concerns about this idea of decentralized governance at all?
I do, but I also think that over time, the token holders are the ones who are most motivated to see it succeed. So that doesn't change, right? If you're holding the Compound governance token, you do want to see Compound succeed. And so I think that long term, that's what's most important is, there's this direct line between those who are receiving votes from token holders and wanting to see the Compound protocol succeed. And so in the short term, there's going to be lots of experimentation. There's going to be lots of experimentation around how votes are delegated, who's voting, why, on what, how is, a new contract introduced, how are parameters changed, like the entire system is now, in a sense, just weeks old. But I think over time, it's going to really harden into like a very solid set of standards that are well known, understood, probably quite boring in some sense, and just as a means of aligning sort of like the long-term development objectives with the community.
Yeah. Do you potentially see? So let's, there's their governance tokens. I want to completely take out the talk of price and price speculation. From there, why would one want to hold a governance token, right? To me, potentially, if you own a share in Compound, you guys, there's a ton of value locked, you're doing a lot of volume. Potentially, token holders could maybe vote in some type of fee and they all share that fee or something like that. Do you anticipate comp holders, finding ways to potentially monetize the protocol?
Yeah, that's entirely up to the token holders. And it's one of the first conversations that emerged in the community is like, can the token holders do this? And the answer is yes, of course they can. The protocol already sets aside a portion of interest as reserves, which is intended to act as insurance. There's obviously a lot of conversations in the community about like, is it possible to have an additional portion set aside for the token holders in order to vote, or when they vote, or for governance, or some structure like that? The answer is it's up to the community. The comp token holders are the ones who control the protocol and the direction that it heads. And so at the end of the day, the comp voters get to decide what comp is, how it works, how it interacts with the protocol. I don't have too many, specific visions for this. I'm actually really excited to just be passive and listen to what the community has to say and where they decide to go with it. And I'm curious as like a passive observer, but anything is possible. If they want to, change the way the protocol works entirely, that's available to the comp token holders. And so it's going to be a great conversation over the next couple weeks, months, years, decades, and to watch how it unfolds. And I don't necessarily think there's any rush because the option is always there. It's not one of those things that has to be decided today. It's not necessary for the protocol to run smoothly and successfully today. It's already running. The counterpoint that some folks in our community keep on raising is like, Amazon was unprofitable for like 2 decades, right? They didn't choose to monetize until they'd already conquered the world. And I think that argument actually holds a lot of sway in my mind, which is there's no need to build, any fees or cash flows into the token. Like, as long as the token holders maintain control of the system, that's the important part.
Yeah, absolutely. Like you said, I'm fascinated to see how this plays out. We're going to have, a lot of different apps on Ethereum governed by token holders. And I think it'll be interesting to see, what direction certain ones go in, what was a good direction, what was a bad direction. And this is one of those topics I think, maybe like you said, not over the next months, but over the coming years, I think is absolutely going to be considered in a lot of these protocols.
Yep. And I think a lot of the experiments being conducted today, like we're kind of like the first movers. We're kind of like, in some ways, a lot of these early DeFi applications are like figuring out for the first time. And, the next generations of these projects will have like a much more clear roadmap of what works and what doesn't.
On kind of getting these funds in and in the years to come, kind of what are your thoughts on how to make these funds coming into Compound sticky? And what I mean by that, right, is right now people are coming in, they're incentivized to lock funds in Compound because they're being awarded comp. Comp has a price associated to it, so it's incentivized mining in a way. How in the future, when this distribution is no longer happening, you said just over 4 or under 5 years left, how do you anticipate a way to kind of keep these funds and incentivize people to keep them in there?
Yeah, it's a great question. I mean, what people seem to forget is that prior to the distribution of comp, there was $150 million of assets supplied to the protocol. There was already like a huge amount of use without a token. And people were using it and devoted to the product and building on top of Compound, the protocol, for years now. And so, I think all of this functions pretty well, even without the distribution of a token. I think over time, that's a question that the community is going to solve in a couple of years.
Yeah, it'll be interesting because there's definitely DeFi wars going on, I would say, at this point with competitors, and everyone's kind of trying to find ways to attract this, I guess, total value lock. You guys, I think last I looked earlier today, are almost at 700 billion, which I mean is very impressive. It's gone up 4 times in the last few weeks or so. So it'd be interesting to see kind of which protocols keep these for the long term.
Yeah, that's absolutely right.
I had asked some people on Twitter to give us some questions, and one of them I thought was really good. If you could, we've been talking about this. This is brand new. It's only been going on for a couple of weeks. You already mentioned you didn't anticipate some things happening. Kind of, if you could go back and almost have a post mortem and change some things about the initial comp launch, kind of what would you change and why would that be?
Yeah, so it's a great question. What we didn't anticipate is that people would be, quote, farming so aggressively so quickly. I think, we've already changed as a community, we've changed the comp distribution formula once, where instead of rewarding, interest earned and paid, the community removed that as a parameter. So now it's just based on like total volume. And this, changed the way like people were interacting with specific markets, but didn't change the sort of overwhelming demand to participate in the protocol. I think if we could go back in time, we probably would have built a system, limiting the total amount of, comp in individual markets that was being distributed. We probably would have capped borrowing in individual markets or supplying in individual markets. One of the funny stories from the very beginning of the comp distribution is there's been this pattern where, everyone goes out and borrows all of like whatever the token is of the moment. They all borrow, Tether, they all borrow Basic Attention Token, or they all borrow DAI. And there's really no limits or ceilings placed on the protocol. If we could go back again, I think we would basically just say like, hey, what's the maximum, amount that we think any market size should be? And we would have placed that in there to begin with. It's a function of not really understanding, we're anticipating the demand from the community. And that would have just been like, a little bit of a safety check. And I think that would have actually led to a healthier sort of initial launch of the protocol. And, I think that's the first and foremost thing is like the first couple of weeks were dominated by like kind of this gamesmanship that we didn't see coming.
Yeah, I'm not gonna lie, I was in on some of that, and it was, the bat thing was hilarious. I mean, there was so much total value lock of Basic Attention Token because basically, like you were saying before the governance vote in the tweak, it was the one paying out the most comp, and it was just wild. Like if you were like supplying ETH borrowing comp, you had to like very actively watch the BAT ETH chart, which who watches the BAT ETH chart, right? Like not many people do, yeah. But because if you didn't, you could get liquidated and all that stuff. But I think, it seems like the comp holders are responding to that and making tweaks as time goes on, which is, I guess, the ideal scenario here.
Yeah, they are. And I was, glad to sort of publicly call out the sort of risks of, yield farming with a volatile token like BAT. I don't think a lot of people understood the risks they were taking, and I tried sort of yelling at the community a little bit to say like, "Hey, slow down! Like, please don't do this." And I think everyone disregarded me, unfortunately. But which goes to show I, hopefully have very little influence anymore. But it has been amusing to watch, and I think it's settled into a thing where, there's still a lot of, um, usage, in individual assets right now. Like the stablecoin DAI is the predominant asset that people are interacting with, and I think if we could go back and change anything, it would have been just like putting ceilings on these markets.
Yeah, that makes sense. Actually, I do want to talk about the risk too. Anytime I talk to anybody building anything in DeFi, I like to talk about the risk. And I think, yeah, we should put this around yield farming because it has become such a meme and so many people are doing it. And, I try to warn about the risk, but I don't know how many people actually listen. But to me, at least when it comes to actually just compound in general, there's two risks that I personally see when I'm using it. It's liquidation risk. And then there's, oracles aren't really, I mean, I guess oracles are a risk if something were to go wrong, but these are the two things I kind of wanted to touch on. Can you first talk about like your warning to the community there and just how do liquidations work on Compound?
Yeah, that's a great question. So the two risks that we try to outline are technical risks and market risks. And market, you could put a lot of things into that bucket. On the technical risks, the protocol is um, developed in the open. It's been developed for a long time. There's tons of security audits. There's a large bug bounty. Technical risks in DeFi are mostly understood. Our team, prior to rolling out Comp Governance, did everything available to reduce those risks as much as possible. If you go to compound.finance/docs/security, you'll see a lot of the work that went into reducing technical risks. And, I think we put in more effort than any other DeFi project in history and probably most other projects combined. um, but it doesn't mean there's no technical risks. Even with all of that effort, there's still always technical risk. And people need to understand that. Any project using a smart contract, there's technical risks. Some, alert users more than others to that fact. Then there's the market risk, and there's a lot of things that go into market risk. This is prices changing in the real world for assets. This is prices moving on a blockchain that are different from the real world. This is assets just not behaving correctly. This is anything that's happening based on prices. And a lot goes into this. And with yield farming, if you're not taking any leverage or you're not using a protocol in a fashion that adds market risk to yourself, you're generally safe. We had a lot of people in the early yield farming days who were like, oh, can I supply Ether to Compound? Is that safe? And the answer is, from a market perspective, yeah, generally. I mean, people have been supplying Ether to Compound for years without a single user ever losing funds. That's generally safe. But other people would say, oh, can I supply Ether to Compound and then borrow as much basic attention token as I can and then sell that for more Ether and supply that to Compound and do this like complex like web of trades? And the answer is like, no, that is not safe at all. You're taking on extreme amounts of risk and subjecting yourself to the fluctuations in asset prices, whether those are coming from exchanges or like, the speed at which those are posted to the protocol. Like you're taking on risk that many people didn't understand. I don't want to chastise, other developers, but like there's products out there that like, help you take on risk you don't necessarily understand. And that's not a good thing. Like I try to, always advertise conservatism in how you interact with these tools. Like if you don't truly know what's happening under the hood, don't use it, don't do it. Don't enter into financial positions that you're not fully comfortable with and fully aware of. And so, with a token like basic attention token, it's a volatile asset. It's not meant to be stable. Like people like these tokens because they go up and they go down. And any participation with them is risky. So I think market risks are not well enough understood by the community. Users subject themselves to liquidation risk, and at the same time, that can subject other users to risk. If everyone in the world is on one side of a trade and it goes horribly awry, that could have a cascading effect in other markets in other unanticipated ways. And so all of it's related and coupled. And so I would always caution people to be extremely conservative about entering into any position with leverage.
Yeah, absolutely. And we all know these markets can move quickly and violently, so you can get stuck very very quickly when it comes to that. How about on your oracles? Can you just give a little insight about how those work? Obviously, that's very important too for people when it comes to risk. Especially if you're locking an asset and borrowing an asset, because if something were to go awry with the oracles, it could create a premature liquidation or something like that. And are these controlled by the comp holders as well? And if not, is there kind of a plan to transition that?
Yeah, the answer is the price feed itself is maintained by the original development team. It's been running without pause for 2 years now, but the comp token holders determine where the price feed comes from. So at any time, the comp token holders can say, oh, like let's have a completely community run price feed. Let's use prices from Uniswap or let's use prices from another system. And that's up to the token holders of comp. They have complete control over every single aspect of the protocol.
Gotcha. So do you anticipate? I mean, maybe this is an unfair question. Do you think? I guess I know you're a comp holder, so I can just ask for your opinion. Do you see comp holders pushing to move away to like maybe a more decentralized mechanism, or is it kind of your thoughts that this has been working well? There haven't been any issues with it, and it's good for now.
Yeah, so far, the price feed maintained by the original development team has had fewer issues than I think any other price feed on the Ethereum blockchain. Period. Whether people like to hear that or not, and that's just the reality. Um, I think and hope that over time, the comp token holders have a system that is completely community run with zero reliance on uh, the original development team. I think that's one of the final steps for the community and the comp token holders to have complete control. And I encourage them to, and I hope they do. I hope they move on to a system that's completely community run.
Yeah, yeah, that would be cool to see someday. But yeah, it's you don't want to just shake things up to shake things up. If something's working, especially when it comes to something as important as this, it's that should be well thought out and done over time. I want to ask one last question about Compound, and then I just have a couple just general kind of DeFi questions for you as well, and a couple things that came in from Twitter too. But what about future plans from the team for Compound? Can you give us any teasers on what might be to come in the future?
Yeah, it's a great question. So, the analogy I like to use is, imagine if you were Satoshi and you make, Bitcoin. What do you do after Bitcoin is up and running? Either you can disappear or you can build something new and on top of the protocol. You know, we're now done developing the protocol itself. At this point, the community is very rapidly taking over development. It's really exciting to watch. There's developers building new features pretty much constantly in our Discord and in the GitHub. And so from here on out, we're really thinking about building services that are tangential to the protocol. We can't say too much more than that right now, but we have some exciting stuff planned.
So you don't want to tease your comp stablecoin to me right now?
It's funny. That's one of the long running jokes in the community. And
Yeah.
people ask in like Discord, they're like, oh, well, can the comp token holders, use the compound protocol to mint a stablecoin? It's like, yes, you can, but why? Like people ask me on Twitter, I'm like, yes, it's technically feasible. You could make the compound protocol create any synthetic asset or do anything you want. You can evolve it in weird, funky ways. You could add a DEX. You could add, whatever product you wanted. Anyone can add a new product into compound, but I just don't see the point.
On that stablecoin question, we recently just saw that USDC kind of triggered their first blacklist of an address on the main chain. So basically 100,000 USDC is locked in an account, and they said it was because of some ask from law enforcement. We don't know the backstory, but the moral of the story is there are centralized stablecoins out there like USDC, which at any moment they could blacklist an address. Kind of, what are your thoughts on this? And I guess generally your thoughts on centralized assets kind of invading is the wrong word for sure, because there's value to these and they're not like invading and taking over, but they are very important pieces to some of these decentralized DeFi applications that we're building. Is that a concern to you as time goes on, as Tether and USDC kind of pick up popularity?
Yeah, I mean, at this point, I think in general, most assets have centralization risks that like trickle down to most protocols, period, right? This goes for Compound, this goes for pretty much every DeFi application. It is a concern. And it's one of the things that I think DeFi is going to be sort of like continuing to navigate for years to come. I don't think there's any easy answers yet for how they work. I mean, I don't know if there's a single DeFi system that you can point to that doesn't have this at this point, unless you're only using Ether and no other asset, period. And so I think it's like one of the harder things that the community has to navigate.
Yeah, like especially when it comes to liquidity pools, right? Like if you're part of a liquidity pool, even if you're supplying, say you're supplying like ETH USDC on Uniswap or something, you're actually at risk too, because if that Uniswap USDC address is blacklisted for whatever reason, you know, it's going to be a race to the exits when it comes to that pool.
Yeah, and I don't think that's unique to Compound at all. I think that's more of like DeFi in aggregate.
One actually very interesting question that came in from someone on Twitter, and this is something I've thought about as well in the past, and this definitely isn't just for Compound, but do you think successful apps like a Compound should find ways to help fund ETH1 and ETH2 development, kind of given such a high dependency on seeing it successful? Is this anything, you know, yourself and the team have thought about in the past?
Yeah, it's absolutely something we've thought about in the past. You know, we've even approached the EF to talk about ways that we could be supportive of the mission. You know, I think there's a lot of questions about, you know, where should support come from to continue building out ETH1, 2, and, you know, the future. And I think it really takes a community. You know, we've been focused really at the application layer, not on the underlying blockchain ourselves, because that's really like our skill set and our expertise. But I think over time, that's something that we might be more engaged with.
Yeah, I'd personally love to see some like consortium of, you know, the top 5 most successful apps come together and create some type of fund or grant program or something like that. I think that'd be a cool thing to see happen in the community.
I agree.
Okay, just kind of last question. I mean, this is just kind of a fun one. We saw it took 18 months for DeFi to go from 0 to 1 billion. It took 5 months for it to go to 1 to 2. We're already, I think, at like 2.2 or 2.3 or something. How long do you think until we get to 10 billion?
Ooh, that's a great question. I think it's 2 years. And the reason why I say that is, you know, most of the people that are really passionate about DeFi are already involved in the space. You know, to get from 1 to 10 billion, it really takes a lot of new participants in the ecosystem to get there. It takes a lot of new assets. It takes a lot more. And I think it's going to be hard. I don't think this is like 6 months away. I think, you know, I think we're going to be, as an industry, pretty pleased if we can get there in 2 years.
Yeah, that'd be a nice milestone to hit. Well, Robert, I always like talking to you guys, you know, a lot going on with Compound and the protocol, and it sounds like some future plans as well. What's kind of the best way for people to stay in touch with you and the team and, you know, just get involved?
Yeah, so we have a Discord that's open to the community, and, you know, there's a lot of great conversations about Compound and, you know, Ethereum in there. Also, you know, just check out the protocol if you haven't used it before. Compound.finance, app.compound.finance, you know, learn about Compound and learn about DeFi in general.
Yeah, absolutely. Totally suggest people do that. Well, Robert, thanks for joining me. I really appreciate it, and keep up the good work.
Thanks, Eric. Talk soon.
Thanks for listening to Into the Ether. You can subscribe to the podcast and newsletter at ethub.substack.com, find our website at ethub.io, and follow us on Twitter at econoar and at Sassel0x.